When it comes to investing, the price you pay is critical in many respects. You can read 50 annual reports, spend 100 plus hours on research, know all the numbers, and you'll still fail. Why? Because of the price you paid, or overpaid. Legendary investor Warren Buffett constantly reminds us of two general key steps towards successful investing. First of all, seek to identify companies with a durable competitive advantages, those that consistently generate above-average returns. And secondly, aim to buy into those investment opportunities at attractive prices. Based on my experience, 9 out of 10 investors don't know how to find the right buy point. Keep watching and I'll teach you. Let's start with what not to do, how to fail. While the price you pay will ultimately drive your returns, don't overly focus on price as a barometer for finding good stock opportunities. The price alone won't cut it, and by all means, don't try to time the market. Ever heard of price myopic? Price myopic is extremely common among investors in the stock market. If the price of a particular stock is going up, we assume good things are happening. If the price starts to go down, on the other hand, we assume something bad is happening, and we tend to act accordingly by selling. Short-term price evaluation is a bad habit. Stock prices shouldn't define performance. Imagine owning a business without daily stock quotes. You'd assess its value through earnings growth, return on capital, management quality, and operating margins. Focus on the business's economics, which determine its future cash flows. Seek good opportunities at fair prices for strong ROI. Don't fixate on stock price movements. Instead, analyze the underlying business for long-term potential. Market volatility can offer chances to invest in solid businesses at discounted prices. Avoid overpaying, even for successful businesses. Learn from the mistakes of others. You can't live long enough to make them all yourself. Eleanor Roosevelt. Here are a few examples of what not to do. Buy just because the stock is going up. Buy just because the stock has dipped and is going down. Invest based on your friend's advice. Dump your money into the next meme stock. Buy without any research. Conclude your research and overpay. Weirdly, the last one appears to be the most common, and I'm here to fix that. So let's learn how to find the right price. How to put a price tag on a stock. Buffett will only invest in a company when he can get it at a low enough price, which he determines by projecting an annual compounding rate of return for the investment, which he feels meets his required rate of return. Let me simplify this as much as possible. The value of a stock depends on the cash flow it's expected to make in the future, but because money loses value over time, we have to adjust for that by discounting those future earnings to present value. Ratios, like the PE, don't truly tell you anything valuable, so we need better methods, and I know of one in particular that is well suited. Discounted cash flow method. The discounted cash flow DCF method calculates the present value of a company's future cash flows to determine its worth today. This is the best method for gaining an assessment of a company's intrinsic value. Here's an example. Let's say you expect a lemonade stand to generate free cash flows of $100 next year. You also expect it to make $110 the following year and $120 the year after that. If you discount these cash flows by 10% per year, the DCF value of the lemonade stand today would be around $290. So, if the lemonade stand was trading below $290, it would make sense to buy it. The only true way to figure out the right price is with the DCF method. I suggest you run the numbers manually because online calculators can't really be trusted. If you ever feel like giving it a shot, check out the Guru-focused DCF calculator tool. Now that we have our number, let's move forward. The final step. All that remains now is to compare your DCF number to the stock price. The best way to reduce risk is by having a thorough understanding of the business, its operations, and confidence in its management. To aid with reducing risk further, buy stocks at prices that allow a margin of safety. For more insights on margin of safety, check out my video, Why Margin of Safety is Necessary and How to Estimate It. Warren Buffett. Link is in the description. Overall, take a look at the DCF number you've established. If it's below, you think. If it's above, you don't buy. If it's way below, you buy. That's because now you also have a margin of safety in case you made a mistake with the numbers. Don't try to time the market though. Rather, always be on the lookout for companies with excellent long-term business economics that find themselves trading at a price believed to be well below their intrinsic value. If an opportunity you're evaluating isn't selling at an attractive price, move on to the next potential opportunity and keep a lookout for any downward movements in the price of the stock, assuming fundamentals remain strong. Conclusion: remember, paying too much for a stock can still hurt you, even with research. But pay a low enough price for the right business, and the returns you earn will be spectacular. Price is what you pay. Value is what you get. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Warren Buffett. If you found this video helpful, don't forget to like, share, and subscribe. And check out the other videos on this channel to learn more about investing. Thanks for watching. Raise your IQ with cutting-edge info, insights, and analysis. Visit and subscribe for free at the link below.